As investors look around the world at what central banks might do next, they seem to be running to the same conclusion. Namely, decision makers are right up against the limit in terms of what they can do to boost domestic economic growth. Now, the victim seems to be the US dollar. The Fed is the only central bank supposedly in a tightening cycle, although it has only banged the drum since tightening 8 months ago in December. This week, the dollar buys fewer euros, fewer yen, and even less pounds. And it's down against the Swiss franc and Canadian dollar too. Even if the July payroll reading matches forecast, investors will be none the wiser about the prospects for a September rate increase from the Fed. And so the dollar seems to be taking it from all sides. The Bank of Japan said it would boost ETF purchases, while the government announced a stimulus package. Both left investors disenchanted and spurred buying of the yen. Despite ongoing concerns over Europe's banking sector and the unknown impact on growth from Brexit, the euro currency also rebounded against the dollar. But the strangest move of all is in the British pound, despite investors' growing expectations of major monetary easing from the Bank of England when it meets later this week. Yet the example of positioning in the pound might tell a wider tale about the fortunes of the dollar. In the futures market, the bulls became bolder and the bears more furious in the latest commitment of traders report released last week. The net speculative position against the British pound rose to its highest on records dating back to 1992. And yet the pound still managed to rise against the dollar. While the example of the pound is the most extreme, it may speak to traders' attitudes towards the dollar. If investors the world over are indeed too optimistic about the prospects for Fed tightening, could this be a bad quarter for the dollar? Thanks for joining me on Traders Insight. For more market commentary, visit ibkr.com/ti.